central banks are saying, I want my gold back. And it's like they want to repatriate. And France has repatriated everything. India is repatriating. Everyone's repatriating. What happens when this is a move that's happening now? So they are coming back. They're coming for their gold. Where do they get it? Go to market to buy it? Well, I mean, what's that? Hundreds of dollars higher? Thousands of dollars higher? Depends on how deep the hole is. To me, I think it's time. It would suit them very well to have a gold revaluation.
Say the U.S. revalues it at, just pick a round number, $10,000 an ounce. Could be $20,000 an ounce, whatever, because they look at it as deficit neutral free cash. That doesn't necessarily mean that gold has to trade at $10,000 or $20,000 an ounce the next Monday.
What if the rising price of gold isn't telling us that gold is becoming more valuable, but that our money is becoming less valuable? That is the argument made by market analysts Craig Hemke and Andrew Maguire, who believe gold remains one of the most reliable measures of wealth in an era of expanding money supply and growing financial uncertainty. Hemke argues that gold itself has changed very little over time. Instead, the steady rise in its dollar price reflects the declining purchasing power of fiat currencies. An ounce of gold that cost roughly $1,100 a decade ago now costs several times more, leading him to view gold as a long-term store of value rather than a speculative asset. For investors who share this perspective, short-term price fluctuations are simply noise. The analysts also challenge the growing narrative that gold is no longer a safe haven asset. They contend that gold prices have been heavily influenced by futures markets and the creation of large amounts of synthetic supply, which increased volatility and weakened investor confidence. In their view, these market mechanisms distorted gold's true role as a stable store of wealth. Maguire raises additional concerns about official gold reserves, particularly those held by the United States. He points to past instances where foreign central banks face delays when seeking access to or repatriation of their gold, arguing that such events naturally raise questions about transparency and the state of global reserves. According to both analysts, the system used to influence gold prices may be under increasing strain. With participation in futures markets reportedly declining, they believe maintaining the same level of control is becoming more difficult. If that trend continues, they argue, gold's underlying value could become increasingly difficult for markets to ignore. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
You save and you're in pounds, and I get paid and save in pounds, and I get paid and save in dollars, and we pay our bills, and whatever we have left over is our own currency reserves, right?
Yeah.
And what reward do we get for that? The central bank just creates more and more currency, effectively devaluing all of our hard work. Like I'm out here digging ditches and breaking rocks all day, but you get the idea, that's what people have, I'm sure, heard me say this before. The gold is the measuring stick. The gold doesn't change. Everybody thinks it's your currency is the measuring stick, because we say gold is dollars per ounce and shares are dollars per share. And everybody thinks the dollar is the measuring stick. And that's not true. Gold truly is. It's a pet rock. It's a piece of metal that collects dust and doesn't pay a dividend and all that kind of stuff. But it's the measuring stick. It just sits there. It's static. It doesn't change. It took $1,100 to buy an ounce of gold 10 years ago. It took $2,100 to buy an ounce of gold 5 years ago. It takes $4,300 to buy an ounce of gold today. 5 years from now, it'll take $9,000 to buy an ounce of gold. And then that's why you see the daily, ups and downs and volatility and, oh my gosh, what's going on here? And it's just like, whatever. Okay, I'll just, if it goes down a little further, I'll buy some more, because the math is the math.
It is. And I think this whole narrative that's evolved, that gold's no longer a safe haven asset. Why? And you see Bloomberg, everyone's talking about, they've latched onto this narrative because essentially, I think personally, we know we all know the WikiLeaks cable. We all know the reason that the COMEX was launched. It was to stop central banks exchanging their dollars for gold, create enough synthetic supply, make it volatile as hell. And so people still question that. And I think, well, just go back and look. I mean, there it is. That was the actual raison d'etre for putting it in place. So you kind of think, well, okay, but how can they still, because they've dug a huge hole. I mean, empirical evidence tells us, Craig, the US Treasury gold isn't 100% there, is it? I mean, it doesn't take rocket science to say, well, hold on, we all know what happened to 2013 and it's 8,100 tons of gold there, and it's being looked after by various central banks. And the Bundesbank says, oh, can we just come and have a look? No, you can't see it. Oh, okay, we can't even audit. We can't actually just look at our gold. No, you cannot. Well, can we have 300 tons of it, please? It might take 7 years. Okay, so, now, if you turned up at your vault and they said to you, oh, no, great, you can't see it. What would you do? You'd say, I want it now. Give it to me, wouldn't you? So, I think what we're looking at here is a situation where the Fed has dug a hole. It's a big, big, big hole. How do you repair that hole?
Right.
And I think everyone may have their different view on that, but I think two things really. They're running out of open interest, enough people to take the other side of their price suppression scheme. They're running out of enough open interest. Whereas it used to be 800,000 contracts, now we're seeing the lowest in almost history. Central banks are saying, I want my gold back. And it's like they want to repatriate. And France has repatriated everything. India is repatriating. Everyone's repatriating. So when they come for their gold, and it isn't there because it sure as heck wasn't there when the Bundesbank wanted it. And in fact, some of that was melt gold. Some of it was brand new bars that were just minted. I mean, and some of it had to be re-refined because it was such poor quality. So what happens when this is a move that's happening now? So they are coming back. They're coming for their gold. Where do they get it? Go to market to buy it? Well, I mean, what's that? Hundreds of dollars higher? Thousands of dollars higher? Depends on how deep the hole is. To me, I think it's time. It would suit them very well to have a gold revaluation.
Andrew Maguire argues that major countries such as Russia and China are increasingly treating precious metals as strategic monetary assets rather than simple commodities. According to him, these nations are accumulating and collateralizing gold and silver, using them to strengthen their financial systems instead of selling them into the open market. This growing demand, combined with industrial and monetary uses for silver, creates a powerful force supporting the long-term value of precious metals. Maguire also discusses the structure of futures and options markets, where large financial institutions often act as market makers. Because these firms are frequently on the opposite side of trades, they have visibility into market positioning and areas where traders may be vulnerable. He suggests that this dynamic can contribute to sharp price movements that trigger losses for heavily leveraged investors. Craig Hemke explores the potential consequences of a major official revaluation of gold by the United States. Using a hypothetical example, he suggests that policymakers could decide to value their gold reserves at a much higher price, perhaps $10,000 or even $20,000 per ounce. From his perspective, such a move would primarily be an accounting adjustment that could significantly improve the government's balance sheet without requiring new revenue or spending cuts. Let's get back to the interview.
Don't forget that we've got Russia, China, collateralizing gold and silver. They're using it as money. They're actually monetizing it. So, and what Russia, 1,200 tons a year they mine. That's what, isn't that like 40% or more of all the silver mined? I mean, they don't sell a single ounce. They're collateralizing it. So of course, these guys, you're up against, if you start shorting silver, you're up against the military, you're up against the US, you're up against Russia, you're up against China, you're up against everyone who is using silver for real purposes. And now you're taking all this paper. And the thing is, to answer the other question, is the House knows where you've borrowed your positions, whether it be options or whether it be or just futures or whatever it might be. They know they're on the other side. They have to be on the other side. As a market maker, you have to be on the other side of that trade. Now, if the House then knows your pain points, then of course, it's like me getting drunk, going to my bank manager, calling him an asshole and giving more money.
That was yesterday. You're telling us what you did yesterday.
No, I mean, but if you know what I mean, it's like obviously you'd let the House know that where your pain points are, and you reach a point where your pain point is, hey, we're going to make money.
Yeah.
Look at the air beneath that position, and bang. Now, I only figure one day, and we talk about revaluation, one day it's inevitable. I know we've talked about it for years, but is there ever a better time? Now that every central bank is asking for their gold back and they're going to come knocking on your door, is there ever a better time to actually patch that up? Well, you ain't going to go to the market to buy it. So why would you not just do a keystroke entry, gold revaluation account, bang, we're sorted. Now we want a higher gold price, like the PBOC do, like every other central bank, like the Bank of International Settlements do. We all want a steady rising gold price because actually it is a really good collateralizable asset.
Say the U.S. revalues it at, just pick a round number, $10,000 an ounce. Could be $20,000 an ounce, whatever, because they look at it as deficit neutral free cash. That doesn't necessarily mean that gold has to trade at $10,000 or $20,000 an ounce the next Monday. I mean, it's an accounting error, but you would suspect that it would, right? It would be like, oh, hey, I mean, I don't know how high. So anyway, in that scenario, do you think they just call it a day? They just say, you know what, in working with the CME, we're going to cash settle all these contracts out at whatever the closing price was back on Friday. And going forward, there are no more gold futures. Because, I mean, somebody that's short even 10 contracts and the price goes up sixfold overnight. They don't have that money. Their clearing firm doesn't have that. Nobody would be able to make that margin call. I just wonder, I don't know, this is all kind of
Taken together, these developments point to a financial landscape that may be shifting beneath the surface. As nations accumulate hard assets, confidence in traditional monetary systems is increasingly being tested, while questions continue to surround the stability of paper-based markets. Whether these concerns ultimately lead to major policy changes or simply reinforce existing trends remains uncertain. What is clear, however, is that precious metals are once again becoming a central part of the conversation about wealth preservation, monetary credibility, and the future direction of the global economy. You could end with one of these questions. If a major reset in the monetary system is closer than most people think, will investors recognize the signs in time, or only after the market has already repriced the value of real assets? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.